Click to Invest plan. This is actually quite a popular plan and a bit revolutionary in nature when it was launched. So it's something which a lot of people buy. So today we'll understand this plan in detail. So it's a unit-linked plan, which means that the money which you invest is actually going into equities, debt funds of your choice. You can choose. If you're aggressive, you can go in for equity-linked funds, or you can go into debt funds which are more conservative and hence lower returns, but still better than what you will get in a traditional plan. So this plan offers extremely low charges, and that's what is the highlight of this plan. Low as in, comparable to the mutual fund industry, even lower than some of the charges which mutual fund actually charges in their plans. So hence it is attractive. Additionally, of course, there is a tax saving component on the money which you invest and the money which you actually get on maturity. So that makes it quite an attractive proposition. So now let's understand how this plan works. You have to decide how much you want to invest regularly. You could invest monthly, quarterly, half yearly or annually. So decide on that amount. I would typically recommend you to go by the monthly mode. You could invest 500,000 rupees every month and keep investing regularly. So it works almost like an SIP. Rather, it works exactly like an SIP. Then you have to choose a policy term, which could be anywhere between 5 to 20 years. Additionally, you have to choose a premium payment term, which is 5, 7 and 10 years. Basis these factors and your age, the sum assured gets calculated. That means sum assured is the total amount of insurance cover which you get in this plan. The money which you invest, you've got a choice of 8 funds to choose from, depending on your risk profile and how much risk you want to take. I would recommend, if you're less than 50 years, going for an aggressive equity oriented scheme. So based on the funds which you choose, the NAV of that fund will determine how many units you will get. And once you get the units, you can track your fund value almost on a daily basis. Now, please note, the most important thing is you cannot withdraw your money before 5 years under this plan. So if you're walking into this plan, you're going to take this plan, please ensure that you have at least a 5-year horizon. The good thing compared to other traditional life insurance plans is once 5 years are completed, there will be no charges deducted on withdrawing or surrendering. So after 5 years, it's good to go. You can actually withdraw without paying any penalty or discontinuing charges or surrender charges. So what's the maturity value which you get? Let's understand this. Suppose you hold 1,000 units of a particular fund which you have selected, and the NAV of that fund is 53.26. So at the time of maturity, 53.26 multiplied by 1,000 unit. Each unit is 53.26. So you multiply that by 1,000 and you get 53,260 rupees as your maturity value. If you have invested into a bunch of funds and not all in one fund, you will have to calculate in each fund how many units you have and the NAV of each one of them. You have a settlement option as to how you want to withdraw your money. Do you want it in lump sum or want to take it through the settlement option? We'll understand what the settlement option is. So settlement option is this. Suppose you have 1 lakh rupees on maturity. You can choose to take it over a 5-year period. So divide your 1 lakh by 5. So 20,000 you take first, and then the remaining 20,000 is there for 5 years, but these will be invested in the same funds which you have taken. So there is a potential that it might increase or decrease, but you can actually, take it over a 5-year period. That's a choice of yours. If you don't want, you can choose not to use that. There will be a fund management charge which is applicable because your funds are still being actively managed by the company. The charges will be actually displayed to you later in this video. What's the death benefit in this plan? You get the highest of the following: the sum assured, the fund value, or 105% of the premiums which you've paid. So whichever is higher of these, that's the death benefit which you will get in case the policyholder dies. Now let's just understand the eligibility criteria for this plan. So it is best to go through this table, which will very clearly indicate, what is the entry age, what is the max maturity age, what are the different sum assureds that you can take. So all this will be very clearly mentioned in this table. Now let's understand some of the other features of this plan. So you've got a partial or complete withdrawal option after 5 years. So once you've hit, no matter what your term is, what the premium payment term is, once the plan has completed 5 years, you can choose to withdraw your entire money, or you can choose to take part of your money also. It's a choice which is again left to you. But of course, the policyholder should have attained 18 years of age to withdraw any kind of money from this plan. Then you have the premium redirection facility. Basically, you're investing in a particular fund, but at a later point of time, you want to actually put your money in another fund. You can do that also, and you've got 4 free premium redirections every year. There will be no charge attached to it, and you can do that 4 times in a year, which is substantial and good enough. I don't think you will require more than that, and don't make too many changes which are unmanageable, and then you won't be able to track it. Then you've got switching. So this is basically your funds are your money is lying in one particular fund, but you want to switch it into another fund because of market conditions, you want to protect it, or you want to go more aggressive. Again, you have 4 free switches in a policy year, which again I think is good enough. I wouldn't recommend too many switches or too many premium redirections to happen. So what happens when you discontinue the premiums? That means you've taken a plan for 20 years, but after 2 years, you decide to stop paying the premiums. So, as I said, if you're stopping before the completion of 5 years, that means your funds will move into the discontinued policy fund. It is not actively managed anymore, and in this, you will only earn an interest rate of 4%. This 4% is decided by IRDA from time to time. So the discontinued policy fund will get you only 4%, and at the end of 5 years, the money will get credited to your account. Now, what happens if you stop paying the premiums after 5 years? So of course, you can withdraw the complete money because it's completed 5 years. That's option 1. Second, you can convert it into a paid up plan. That means you've paid premium for so long, so I don't want to pay it anymore, but I want my life cover to continue. So you can do that. I wouldn't recommend going with this option. Third option is, after a gap, you can revive the policy. That means you missed a premium, so you come back and then pay the premiums and continue with this. There will be no interest charged on this revival or this premium which you've missed. Most insurance plans actually charge an interest rate on this, but in this case, there is no interest charged. A loan. Unfortunately, this plan doesn't allow a loan facility. So in case you want a loan against the funds which are lying, you cannot take that. Surrendering, as I said, you can do it at any point of time, but before 5 years, you will not get your money back. But if you do it after 5 years, you can withdraw your complete money. A grace period. In case you forget to pay your premiums, you have 15 days to actually pay your premiums from your premium payment date. Again, not recommended. Just stick to the schedule which you have paid, maybe 3-4 days before that, or set up a standing instruction in your with your bank so that it keeps going regularly and you're not in trouble. Tax benefit. Of course, this plan qualifies for tax benefits. The premiums which you pay have benefits under Section 80C, and the amount which you get on maturity or surrender, or after 5 years if you withdraw, they are eligible for tax benefit under Section 80D. So what are the fund options available in this plan? As I said, there are 8 fund options, and they are listed from aggressive. That means you can say it as high risk and high return potential. So they are typically invested in equity. Equity means stocks of companies which are listed in the stock market. So and you have lower risks which come down. So you can refer to this table, which very nicely indicates the kind of risks which are there and the portfolio which the insurance company invested in what ratio. So you've got Equity plus fund. So you will see it invests 0 to 20% in money market instruments, cash, deposits, liquid mutual funds. Then 0 to 20% will be done in government securities, fixed income securities. 80 to 100% may actually be invested in equity. So if you see the last column of this table, the risk and return rating is actually pretty high. If you're young and you plan to stay invested for 5 to 10 years, I would recommend going in for the slightly more aggressive and riskier portfolio because the chances of getting a higher returns are much better. So the others, you can just go through this table again. You've got a diversified equity fund, you've got a blue chip fund, you've got an opportunities fund, you've got a balanced fund, income fund, bond fund, and a conservative fund. Now let's understand the different charges which apply in this plan. And this is where this plan actually scores pretty well and is comparable to the mutual fund industry. So this fundamentally has only one charge which is there, which is the fund management charge, and that is 1.35% charged annually on the fund value. This is actually less than some of the mutual funds itself. Then of course you have the mortality charge, which is in relation to the life cover which is being offered to you. That's actually quite a small amount. In case you want to do a premium redirection, then 4 of them are free in a year. After that, you will be charged 250 rupees for every premium redirection that you do in that particular year. In case you register it online and do it yourself, then only 25 rupees would be charged. Similarly, for switching, you have 4 free switches in a policy year. But after that, if you request the insurance company manually or through writing, 250 rupees will be charged for every switch. But if you do it online yourself, only 25 rupees will be charged per switch. For the partial withdrawals also which you do, you again have 4 free partial withdrawals in a year. Again, if you do more than that in a policy year, you will be charged 250 rupees. But if you do it online and place that request, only 25 rupees will get charged. Now let's just understand a question which keeps coming quite often. So I'll spend some more time on it. What happens if you actually stop paying the premiums before 5 years? I explained it earlier, but let me just elaborate on it a bit more. You've taken a plan for, let's say, 15 years, but within the first 5 years, you stop paying the premiums. So your money actually goes into a discontinued policy fund. And in this fund, only 4% interest will be provided to you. So it's not an actively managed fund, so hence 4% is provided to you. A fund management charge of only 0.5% which will apply, which if it was being actively managed, it was 1.35. But in this case, only 0.5% will be applied annually. No other charges. Of course, you have the option of reviving. That means, maybe you missed a year, but after that you realize I am capable of actually paying. So you pay it, and the due one also you'll have to pay, but you can do it without any interest being charged, and then you can activate your policy. And after 5 years, you can withdraw whatever fund value is there in this, or if you've actually revived it, you can continue till your policy term. That's pretty much what is there in this plan. In case you have any questions, please feel free to ask, and we will be happy to provide our inputs. Just drop a comment and we will get back immediately. Thank you. I hope you found this useful.